Hello, it's Carl here from Barron Co Advisory. Happy Wednesday, the 22nd of November. I hope you're all well and that you're enjoying some of this magnificent sunshine behind me. It's a hot one here in Melbourne. Today, I just wanted to take it back to basics because there's so much complexity in the market and the lending system at the moment, which has come in over the last 24 months as a result of some legislative changes. So APRA, being the government regulator, have introduced all sorts of measures to control the level of investment and interest-only lending in the market, and it can be quite overwhelming. So it's never been more important to seek professional advice to navigate your way through all of these changes that have taken place. But I just thought I'd take it back to give you some sort of framework around what the bank's interested in. So they're really keen on understanding what risk they're taking, and that's the main thing that they're looking at. So, they set their interest rates on risk, they set their lending policies on risk, and they definitely set their fees on risk. So things like lenders, mortgage insurance, and so forth. The more risky you are, the more expensive things become. So I guess just to give you a framework around what they're looking at when they're assessing your home loan application, I thought I'd talk about the 5 C's of credit, which is what my very first lending manager, Mr. Mark Jones, g'day if you're watching, he took me through as a 19-year-old, as I say, all those years ago. So the 5 C's of credit: character, capacity, collateral, capital, and conditions. Sorry. Yeah, as I said, really, really important to understand what the bank goes through. So when I talk to my clients, I talk about what the bank's interested in, and then what you guys should be interested in terms of your decision and what's important to you guys. So the first one being character. This is where the bank completes a credit check on you. They check to see if you've made all your payments on time on existing home loans or existing credit cards and personal loans and so forth. They really build up a picture based on all of this information on your character and your commitment to repay debt and whether or not you've had any issues in the past and so forth. So it's a pretty straightforward one, but also really, really important. So capacity is the next one, and this is where a lender will look at your net income less any living expenses, any other existing debts and so forth, and they complete a borrowing capacity assessment, but they do this at a higher benchmark interest rate. So whilst your home loan interest rate might be say 3.69, which is a really competitive owner-occupied variable rate in the market at the moment, they also will complete their calculations at say 7.5% or even 8%, depending on the lender. So really important to understand that they do go through a fair bit of work around understanding what your true living expenses are, and that's actually going to become more and more prevalent over the coming years, and I'll get into that in more detail at a later date, because there are some big changes coming in the way banks assess your existing expenses, but other financial institution debts, and also your general day-to-day expenses and the visibility they will have over that as a result of some changes that are coming. So we'll talk about that at a later date. Capital is the 3rd C of credit, and that's really just talking about what you're bringing to the table. So you're bringing cash that you've saved over a period of time, or you're bringing equity in another property, and that equity can come from parents as well. Sometimes that's offered by some lenders, where parents are helping their children get into the market because it's because of the prices, etc. So they'll take a security over one of their properties by way of a limited guarantee. So that's definitely an option in terms of capital and getting into it. What's the third one? So the 4th one, sorry, is collateral. So collateral being the 4th C of credit, that is really about what the bank is going to hold as security. So they want to make sure that the property that they're taking on board is acceptable security. So buying a renovator's delight that has massive cracks in the wall, has sagging floors, is missing a kitchen, is not acceptable collateral or security for the bank. They want to make sure that they've got a property that can be resold down the track if required by you, or by them if in the worst case scenario. So definitely keep that in mind. Collateral is really, really important. So the type of property you select will go a long way to determining your approval. So make sure you speak to your advisor about that before you actually buy. And the 5th C of credit is conditions, and that's just working out what interest rates are applicable, what the terms are of the loan. Is there going to be an interest-only term, and so forth. All of that helps them to build up their decision. So what type of loan are you actually applying for? Is it suitable to your needs? doesn't meet your requirements. So, and they're responsible, they're NIC guidelines as well. So yeah, so that's the 5 C's of credit, guys. If you've got any other questions, feel free to post a comment, call me, whatever you need to do. But hopefully that gives you some sort of idea around how the banks look at things. It's an oldie but a goodie. Take care soon.